And welcome back, everyone, to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Hey, everybody.
Today is March 11th, 2022. Still a lot of excitement and buzz in the markets. The thing that I continue to see all week on my feeds is the gas prices, and it's really
Yeah.
becoming a social issue. I'm seeing a lot of memes. What are you seeing? How's it affecting? What are your thoughts on the markets there?
Well, the price of gas is going up. In the geopolitical world, we know that by everybody rejecting Russian oil, that means that we're on a global scale. Everybody is, some people that are kind of smaller in mind say, well, why don't we just drill, baby, drill, right? That was the big thing last time we had high prices, which was about 10 years ago. I remember some lady named Sarah Palin came on the scene, and she was all about drill, baby, drill. But you're not going to drill yourself out of this because we trade oil on a global market. So the truth is in the U.S., even though we said we're not going to take in Russian petroleum products, I mean, that's like a drop in the bucket for us. We don't really take in many. Like, I think it was like 7 or 8 or even 9% of our petroleum. We can easily find that elsewhere, but it's the prices set on the global markets, right? Well, the other thing we have to think about, because I know here in Washington, D.C. area, the governor of Maryland is saying, hey, maybe we'll suspend the tax, right? When you go to the pump, I know in Maryland, because it's been all over the news, the Maryland adds 36 cents per gallon for tax. And so he's talking about suspending that 36 cents a gallon temporarily to keep the price where it is. And he put a little contingency on it. He said only if people in DC and Virginia do it too. So he's like making sure that it's a group deal on dropping the tax dollars off of it. But what's interesting is that's like a flat amount per gallon. But if you look at the companies, like let's take a look really quick at like ExxonMobil, XOM. You'll notice that they're all at record highs. And the reason is because they have a margin percentage. And so all of these oil and energy, if you look at the energy sector price, here's another one, ConocoPhillips, COP. All of the companies that are in the oil world, with the price of oil being so high and them making for instance, I'm just going to throw a number out there, 5% gain on the price of oil. When the price of oil goes up, their 5% share goes up. It's not a flat fee like, for instance, the state taxes are. So I mean, if anything, this gives us an oil play. Even the smaller companies like Marathon Oil and some of those players, they're all at record highs because of this. So, I hate to make light of what's happening in the Ukraine, but because the oil price is so high, if you wanted to capitalize on this as an investor, maybe you want to look at the energy sector, either to play the rush or even play there's got to be a crush in the future. It's gonna, it can't be this high.
Yeah, and we're gonna go over an example a little later on, more specific into an oil play. But I am curious as to the rise so quickly, right? The last time around, I assume it took a little, longer. I feel like this latest spike is literally like 2 weeks, and it's just like records across the board.
Well, we got to remember that the price of oil, and it's a future contract, it's futures, is not necessarily just the commodity price of oil. I mean, we can look at the commodity price of oil, but there's also, when you're talking about the futures on oil, there's an anticipation, or there's a fear factor. It's basically the number of people buying these futures at the low prices is raising the price of oil. In other words, out of desperation. It's kind of like what we saw 2 years ago when people were like buying toilet paper off the shelves at the grocery stores when they had a little bit of fear that this was the end of the world. And it's kind of like now that we think that oil prices are so high, so many people are running to buy and fill up their tanks, and it's going up through the whole chain. So there's some of that in there as well. And like I said, this is also a perfect time for companies to be jacking up prices behind the scenes because they have a reason to. So, what must go up will come down. Yeah, I'm not I always group this into what I would call a transient external stochastic shock. So it's transient, meaning it's going to go away. It's just one of those blips on the radar. And I even noticed that, for instance, with the Fed and their discussion about inflation, they're not really even factoring in to their decision around interest rate hikes and quantitative easing and things like that. They're not even factoring in the price of oil.
Yeah, and that's what I was gonna chime in on next is that correlation, right? Because we've been seeing inflation rise rapidly over the last couple of months, and now this huge spike in oil can only pack onto those numbers. So I'm curious, right? We had some data this week. We've got the Fed meeting next week. I mean, oil's got to be in the discussion somewhere, right?
I'm not sure. They make their decisions on controlling inflation and controlling monetary policy on a much bigger, with a much longer time frame thought process than what they feel like this invasion of Ukraine is going to last. So I'm not sure that they're even factoring that in. But what you were talking about is this consumer price index that was released yesterday. So the consumer price index that was released yesterday came back. This is basically inflation of the price of things, right? The stuff. And so if we click on this and we look down and drill down into the details of this, you can see month over month, they're saying prices increased by about 0.8%. And year over year, this was the number that got people talking, 7.9%. But when you pull out food and energy, the number is a lot different, right? Instead of jumping up as much as 0.8%, when you factor out more volatile food and energy, prices went up only a 0.5% or 6.4% for the year. So more than likely, the Fed is looking at these numbers that don't have the more volatile food and energy. Don't forget as well that because of this skirmish out in Europe, a lot of our food prices are going up, right? Because not only is the Russia a big participant in the oil world, they are also in wheat and a lot of the other commodities, right? So look for your bread prices to go up temporarily as well.
Yeah, and I just saw that or this morning there were more sanctions. I guess we're going to be sanctioning vodka, Russian vodka, and seafood.
Oh,
Hey,
so but the other thing that the Fed is going to factor in that's not shown in this consumer price index is also the inflation of job wages. We talked about that last week with the employment report, and wages from jobs have stalled this past month. So I actually don't think the Fed is going to be as aggressive on interest rates as we think. I think if anything, it's going to be what they've been talking about, the quarter point rate hike, which is a quarter of a percent increase in the interest rate. But also, I think that we're going to see a lot around the quantitative easing coming to a halt, if not reversing.
okay, so let's just say, for example, they do the 25%. That's not going to move the market much because we're all expecting that, right?
Yeah.
Okay. And this is the quantitative easing that you were describing.
Yeah. So remember, the Fed has these toolkits that it uses, and traditionally it uses interest rates in order to control the flow of money, right? If they make money easier to get a hold of, people will spend it. If they make it more expensive to use, then people will hold on to it. And that's kind of how they've done it to date. Now, up until the last Great Recession around 2008, they never used this other tool, which has gotten the name called quantitative easing. I think the Fed balance sheet up until that point was something like $700 billion, which is like nothing compared to where it is at 9 trillion right now. But during the Great Recession, a lot of the European central banks went the route of doing negative interest rates. That meant they were actually paying people to use money. And our Fed decided that that was not going to be a smart policy, that it was actually better to not keep your money in the bank. They were actually paying you to take your money out of the bank. That's what a lot of the European banks were doing. That's whenever you hear the word negative interest rates, that's what they're doing. They're basically saying, we're going to give you money. Um, and if you store it in the bank, we're actually going to charge you. We're not going to give you interest. We're going to charge you for putting your money in the bank. We didn't go that way. Instead, what we started to do in order to keep things flowing, right? When you think about an investor, a financial planner for you, they typically like to put half of your money, if you think about it, into like bonds, which are very secure, and half of your money into stocks. That's always been the gameplay for a traditional financial planner for people's investment dollars. When you start having the Fed buy bonds, and that's what they did, they started to buy very secure treasury bonds, and they started to buy very secure, like the best mortgage bonds, right? And by doing that, they made bonds really like not good at giving interest, right? They made the bonds, by them buying them, there was such like this demand by the Federal Reserve for the bonds that they did started to not pay any interest rates. And so that caused the financial planners to kind of skew people's portfolios, and all of this extra money that would have gone into bonds was now going into more riskier investments like stocks. And that explains why Wall Street's at these all-time highs. I mean, ever since 2008, the Dow has gone from like 8,000 up to 28,000. It's gotten like a 3 or 4 fold increase. And that's because all this money that the Fed is putting into bonds is causing regular investors to be attracted to things. And it's gotten so crazy. So you can look at that they continued that bond buying after the Great Recession until about 2014, where they finally cut off the spigot. And then when they said they were going to start to buy things back, when they were going to start to get rid of this cash, they were going to sell these bonds and sell these mortgage stuff. They were going to put them back out on the market. Wall Street freaked. And so the Fed basically marked time for 3 years or so until a lot of those treasuries started to come to maturity, right? When you buy a treasury bond, they have a maturity date. And so they were buying a lot of 3 and 5 year treasury bonds. They started to mature. And so as they mature, they started to cash them out. And that was working until, they started to worry that the economy was slowing too much. That was under the Trump administration. And so they started to do just some gentle buying again of these securities to get people back interested in more risky investments. And then, of course, COVID hit. And as soon as COVID hit, they decided to even go a little bit more aggressive. Instead of the best treasury bonds and instead of the best mortgage bonds, they started to buy corporate bonds, still the highest class, but they started to buy a whole bunch of other types of bonds. Again, getting people attracted towards those more risky investments because bonds were just not paying off, because bonds were basically being bought by the Fed, by this created money. And they've continued that buying process up to the point where now the Fed owns $9 trillion worth of these bonds. But what they've noticed, and you might remember, Sip, we talked, I think it was around show 10. I know we're on show 21 now, but around show 10, we talked about these SPOQ, the SPACs. And we also were talking about NFTs and crypto. I mean, at this point, there is so much money, and the traditional investments are so not worth anything. Nobody's interested in them, that all this spare money that usually is split between bonds and more risky investments, we're seeing, the Fed is talking about, hey, man, this NFT thing, the crypto, which has no backing whatsoever. These are really risky investments. We see this real estate. People are investing in real estate like there's no tomorrow, and they're buying like a whole bunch of crappy, all this extra money is now starting to go more than just into the, secure, more secure risky investments, and it's going into crazy stuff. The SPOCs that we were talking about, and the Fed and the Treasury Department are getting very worried. So they've been talking about not only stopping it, but being way more aggressive than they were a decade ago at selling those things back to get people to stop investing their money into these really, really speculative things. The government's worried. And so I wouldn't be surprised if at this next Fed meeting, I wouldn't even. There's a slim chance that the Fed may, especially because of what's happening with the Ukraine, surprise us and not move the interest rate. We'll see. Otherwise, it's probably going to be the quarter point. But I am going to be reading in between the lines about this quantitative easing to see if, number one, they stop buying, and number two, issue some sort of timeline for selling back, because I have a feeling that by 2030, in just a short amount of time, they're going to want to get rid of about a third to even half of this $9 trillion, bring us back to this level, I think. So that would be very significant. And that means that, man, you better be brushed up on shorting and buying your put options, because if you're just all about going long and buying things like crypto, buying things like real estate, buying NFTs, I think you're going to be on the losing side of the equation.
Well, this was a great example in explaining the quantitative easing. I know that I definitely picked up a lot. And I just have a quick question on that. When the talking heads mention QE, am I to assume that that means quantitative easing? Like, is that the acronym?
Yeah.
Okay,
Yeah,
cool.
and that's not, that name is, a buzzword. That name came around by the media. It's basically asset buying. So the Fed, instead of going with negative interest rates back in the day, they decided to try this new thing that they had never done before, which is asset buying. And the media, the folks over at CNBC and the Forbes and all that, they decided to label it quantitative easing, and then that kind of stuck on, kind of the way that like Obamacare became the name for the Affordable Health Care Act. So yeah, QE is exactly that. So I'm expecting them to announce that QE is going to stop, or they're going to come up with a very short-term plan. Like, I have a feeling that this year QE is definitely going to stop. They're going to stop buying all these assets, and they're probably going to look at how quickly they can narrow down the Fed balance sheet, and that's going to affect Wall Street. There's a lot of bubbles that have formed in all of these risky asset classes. And so I feel very, positioned well, Sip, because I know how to trade the markets down. I got all the tools in the world in order to trade these down markets. So I'm not worried. But if you're have only been swayed into the market because you think only prices can keep going up, especially with these things that are more risky, like with no backing, I think the government has a different idea.
Yeah, and so if anybody's new to the show, to the channel, and they're watching and they haven't gone into AJ's workshop, he does have a daily workshop where he breaks down some of these strategies and ways to take advantage of these, things that are going to happen in the future, especially if the market falls to the downside. There are these amazing tools and strategies that allow you to make money if that happens. And so we're going to go ahead and go into a few examples in a moment. But before we do that, we're going to go ahead and play AJ's commercial, entice you to sign up for this webinar. I'm going to go ahead and leave the link in the comments. And as we go through some of these examples, if anyone has questions, feel free to drop them into the chat and we'll get to them as we can.
Mm-hmm. I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. Wonderful. So, our first example that we're going to go over, I believe, is one that we've covered on a couple of episodes and might actually be affected by some of this recent supply chain constrictions. And that's a former favorite of mine, Wendy's. I've, changed up my diet. So they're out of my menu options lately. But Wendy's, what do you got for us, AJ?
Well, I just wanted to report back on Wendy's. So you guys might remember that when Wendy's was up at its high, we were shorting Wendy's. We were basically buying puts. So shorting the stock and buying puts, a specific strike price, specific expiration date, you can get the same effect. So we were actually betting against Wendy's when it was at this peak over here. So we shorted it. And then what was really interesting is when Wendy's started to come and say, okay, I'm done going down, I'm going to head back up. Instead of, buying back that Wendy's at a lower price or selling our puts at a higher price, because that's the way puts work. They work inverse to the stock price. We did something else. We decided to play our classic premium selling. So we sold some puts, so made some money off of selling some of these puts. These were near-term puts that were at the money versus these puts that were far out in time and deep in the money. So that's something you guys have to understand, is that the options behave differently depending on the strike price and the expiration you choose. And so again, it's the difference. Somebody came up to me and they said, "Hey, is it as easy as selling calls or puts?" No, it's actually quite nuanced, but it's also not as difficult as many people play it. When you've got expiration date and you've got strike price, you can kind of start to understand what it means to choose the different strike prices that are deep in the money, at the money, out of the money, or deep out of the money, and expiration dates. Options that are going to expire in the next few weeks versus expire in the next few months versus leaps, which are going to expire in the next few years. By choosing those options, we can get them to behave differently. So when we were shorting or wanting to get the same effect of shorting the stock when we were back in the turn of the year, we were using deep in the money, far out in time options. When we wanted to make a quick buck by selling options, we went ahead and sold the near term, meaning they were going to expire in about 3 to 5 weeks. In this case, they were going to expire on February 18th and at the money. So we sold the $22 strike price and we just waited. Oh, I forgot. We also protected ourselves. So when we had this sold premium, we collected a couple of bucks up front. We wanted to protect ourselves against this going too high. So we bought ourselves a protective call. I think it was, around the $24 strike price, so that if that went too high, we would have a risk protection. So what happened is as we went up and then started to go back down, this protective option, this protective call, went up in value. And once we were out of the danger zone and we started to head back down, I sold that protective call for a profit. So not only did that protective call give me protection against the stock going against my initial trade, but it also wound up giving me a few extra dollars per share of profit. And because the underlying symbol did not close below $22 on the expiration day of that near-term option, I got to keep all this money too. So I made money 2 different ways on this symbol, and then I just did it again recently. I went ahead and sold some premium and bought my protection. And then after this down day here, I went ahead and got rid of those 2 trades, and I'm looking to do it again. So I can actually do those 2 trades. I can roll both of those trades out this month. And so I've already collected 3 paychecks on this Wendy's symbol. I'm using a combination of what I call the fast MACD. It's the MACD programmed with a 6, 19, and 3 in order to give me the signals. A combination of that and our fast reversal identifier. So we have this fast reversal identifier that we use that finds these bars that are really fast, big reversal bars like these. And so anytime there's a big reversal bar, my automated trading, the beautiful part about this one, Sip, is I didn't do any work during the trading session. I just programmed my trading platform here. I'm using Thinkorswim, but we also have the program in for TradeStation to go ahead and do this trading for me during the day. So it was constantly watching the market for some simple moves and placing the trades. And I was only coming back in the evening for about 5 or 10 minutes every evening, calibrating it. Right. I definitely, this was a hands off trade. And for me to have already made 3 paychecks off of it, I'm pretty stoked.
Yeah, and Wendy's continues to really find itself in that range over and over and over again, at a really good stock price of, 21 to $24. So yeah, I'm sure this is definitely, gonna stay on the radar.
The other thing about it is, remember our initial position, and that initial position is so important. That initial position covers us from selling. A lot of folks have written in and said, "Hey, I like the idea of selling options. Can I just sell calls and sell puts?" What's important is you understand that when you sell options, you're basically putting yourself under an obligation, and your broker, in order to allow you to sell these options, is going to make sure that you can cover that obligation. So, a couple of ways to cover that obligation. One way to cover that obligation is just have a whole bunch of cash in your account, but that's not the only way. The other way that you can cover your obligation to be able to sell options is to set up these initial trades. In the case of selling puts, you need to have either a stock that is shorted, or you need to have, like we used, a deep in the money, far out in time put option. You have to have another put option that you have bought in order to cover the one that you sell. And if you're going to be doing calls, you have to have the opposite. Instead of shorting a stock, you either have to own the stock, or you have to have owned a deep in the money, far out in time call option, something that you've bought that you could sell in order to cover the obligation. Because your broker doesn't care about technicals. Your broker doesn't care about, hey, this risk, this trade looks risk free because there's a reversal. Your broker doesn't care about that. Your broker is looking at what's the worst thing that can happen, and can you cover your ass if that happens. And so they want to make sure you can cover your position. So that initial trade is so important to place. But the other thing is if we play our cards right and we set that initial trade up right, and the underlying symbol has maybe a gentle lowering in price like Wendy's does, when we're done making these paychecks off of Wendy's by selling the premium and rolling out our protective options, we can still make money in the back end because our initial position works as well. So I like to get all cylinders firing when I do these positions. I like to think them through in advance and get all cylinders firing. And so far, Wendy's is just textbook. Very low effort, paychecks, and it looks like we're going to have a nice payday on the back end.
Wonderful example. Love it. We'll keep it on the radar. We'll see what transpires in the next few weeks. Another big piece of news that came out yesterday, which I thought was very surprising, but exciting at the same time, is the 20-for-1 split of Amazon stock.
Amazon,
Right. So
AMZN.
we have a question from Nicole in San Diego. Curious as to how to play that news, and I'm also curious to know what your thoughts are.
Well, okay, so first of all, the market likes this, right? As soon as that news when it announced, the price of Amazon skyrocketed up after hours, and you can see here in this little bar, this is where we closed on Wednesday. This is where we opened on Thursday, but it looks like already investors are over they've digested that information, and so great. The excitement is already waning off. What it means, of course, is Amazon. This is a play right out of the Apple playbook, by the way. Remember, Apple did a split when their stock price was up at about $1,000. They did a 10-to-1 split. And their reasoning is if we lower the stock price, we know how dedicated our consumers are. If we can make our stock price affordable, maybe those tried and true um, consumers would be considering being investors as well. And it paid off for Apple. Apple has a very loyal base, and as soon as the Apple stock price was affordable, they saw a whole bunch of people come off, out of the woodwork to buy their stock. And I think Amazon is playing the same thing. Their stock is up close to near $3,000 a share. That's way too expensive for the average Joe who buys an Amazon Alexa or something like that. So they're going to be reducing the price of their stock by doing a 20-to-1 split. So it'll come down to about $150, maybe a little bit less, which is more in the price range of what a typical consumer is. So they're looking to find more investors out there that'll be loyal. Now, I don't know if Amazon has the same loyalty base that Apple. They're playing a little bit of a Hail Mary play there, but honestly, a lot of people, especially after COVID, have really dug the ease of using Amazon to buy stuff. A lot more than even before the pandemic. I think that we got into a whole bunch of mainstream people, not just early adopters and people like that. So I think this is a smart move, and I think that if you ever wanted, like for Nicole in San Diego, if you ever wanted to own Amazon, now's the time you might want to think about doing it. I wouldn't, whether you buy it, if you have the money to buy it now, that's great. Otherwise, you're going to wait for the split to happen and you'll buy it at the lower price. It doesn't matter because if you buy it now, um, you'll wind up getting 20 times more shares. So what some people who are thinking about selling premium about with it is they're buying 5 shares, because if they buy 5 shares, they'll have 100 shares uh, um, after the split. And once you have 100 shares, you can then start selling premium against it. So people have gone out buying 5 shares of Amazon often, over in the last 2 days, so that they can go ahead and sell call options against it. The other thing you can do, of course, is you can sell your puts. So you can, if you want to pick the price of Amazon that you're willing to pay for Amazon, you sell a put and you have the cash in your account to pay for the price of Amazon that you set it out. How do you set it? You pick the strike price. So for instance, right now, say for instance, I'm willing to pay $2,800 for a share of Amazon. I could sell the near term $2,800 put. So let's look up the price of the near term. Here it is. Amazon near term. This is the one expiring next Friday, and I'm willing to pay $2,800. And I have to make sure I have $2,800 in my account in order to pay for it. Gosh, there's a lot of options. I'm scrolling. Okay, here's $2,800. So if I wanted to, I could sell this thing. I would make roughly $21 a share. Now, remember, when you sell a put contract, it's 100 shares. So I would make $2,100. And if the price of Amazon comes around $2,800, I'll wind up getting that stock. And $2,800 per share times 100 shares. So 28, what is it going to be if I'm put 2 zeros? 280,000. Yeah, that's right. $280,000 will be deducted from my account, but I'll get Amazon at $2,800 per share. And when this splits, I'll get 20 shares for every share that I purchased. So if you want to set the price of Amazon that you're willing to pay, so right now Amazon is trading at $29.48. If I want to set the price that I'm willing to pay and I have the money to buy it and it's just sitting there in my account, I sell the put with that strike price of what I'm willing to pay. If it doesn't go through, if March 18th rolls around next Friday and nobody was willing to sell me Amazon for 2,800 because they could go sell it on the market for 2,945, fine. I just collected the $2,000 and I can do that every month. I could keep rolling, and if nobody's willing to sell it to me at that price, I get to collect a premium. It's kind of a neat concept because I get to set the price that I'm going to buy it at, and if nobody's willing to sell it, I collect a monthly income. So I can do that every month until somebody finally sells it to me at my price.
It's a beautiful thing, and we preach it every episode.
Yeah.
But it's exciting to have the 20 for one split. Uh, Amazon's definitely been a big boy stock for quite some time here, as your examples just presented. So this should make things exciting, I think, for the rest of the year. If it can find some sort of a range, maybe we'll have a setup.
Yeah.
Moving on to Ben from Montreal. And this is kind of similar to what we touched on in the beginning of the show, and that's an oil play. But it's this thought that you're not going to get into directly the futures contracts, but you can kind of, play the moves using the popular equities, and Chevron is one of them. And I think his question was, what can he do here?
Yeah. The question specifically from Benoit was, uh, is it as easy? I want to play the uptick in Chevron, I think is what he asked. I want to play the uptick in Chevron. Is it as easy as buying calls? Okay, so I think we're simplifying what options are. And I kind of hinted on that earlier. Um, it's not as easy as buying calls. And if you buy the wrong calls, it will actually work against you. So you have to buy a specific type of calls. So first of all, let's just talk about the option piece, and then I want to backtrack on kind of your thought process of getting in, because I think you're about a month late for that signal, and I think that could also create a problem for you. But let's first talk about how to select options. So first of all, options have a component of them that wastes away with time. And it specifically is if you're using at the money options. The at the money options have the highest component of wanting to waste away with time. So if you're thinking of using at the money options, these are options like, for instance, we're trading at $170, $171. If you were to buy the $170 call, that thing would want to waste away with time. The value of it would want to decay very quickly with time. And so you already have kind of a tidal force against you, a current against you. You're swimming upstream with making that kind of decision. And so one of the things, here's a neat graph, and I'm just going to pencil it in, but you can look it up by searching in Google for options time decay. And this is really neat because the price of options decay with time, very similar to the human nature of procrastination, right? When we are given, for instance, a task that has a deadline, human nature says we're not going to do much on the task until the deadline gets really close, and then we're going to start bullying the project until it's done. And that's exactly what happens with option prices. That decay with time is very, very slow until we get close to the expiration. And then all of a sudden, the decay with time goes very fast. So if you're interested, Ben, in buying call options that are at the money, I would recommend going very far out in time so that that time decay that's going to be a current against you is a gentle current instead of a strong current. I've seen the mistake of people buying options that are 1 month to expiration. Like, for instance, they're buying the March 18. That's even 1 week to expiration. Or they're buying the April option, which is like 5 weeks to expiration. And they're wondering, they're like, isn't this call option going to go up with the price of the stock? Sadly, that call option that you picked is going to have more force going against you. The price of it's going to drop because it's a wasting asset. So if you're going to do an at the money option, let's use an option that's like 6 to 9, even more than a year out to expiration. And that way we won't have that time decay. But even more, the other thing we can do to help the option behave the way we want to is, instead of using an at the money option, we can pay more for an in the money option. An in the money option has more connection. It's called intrinsic value, more connection to the stock price. So if you're trying to create a scenario where the stock price and the option behave almost exactly the same, you want to go deep in the money. And that can counteract the time decay thing, and that'll counteract the volatility effects on option prices. So deep in the money, far out in time options are the type of options, as a rule of thumb, as a guideline, that we want to be buying if we want to track a stock move. So if you're looking to play Chevron, it's not as easy as just buying a call. Buy a call that's deep in the money, far out in time. But the other thing I want to question about your thought process is, um, the price of oil is up and there's already a whole bunch of people stepping in to create bumper guards, to create guards against the price getting out of control, because otherwise the world population will start to get upset, and no government wants their world population to get upset. So in my mind, it's almost you almost missed the boat here. You almost missed the opportunity to be buying into Chevron. It could go higher, but we generally don't want to buy high expecting to sell higher. What I would be doing is just the opposite. I would be positioning myself in order to take advantage of the uh, probable drop in price. Now, I wouldn't be doing any security buying, but I would be planning out the purchase of put options. And again, if I'm buying put options, I want to go out in time and I want to go deep in the money. I don't want to use near term at the money options. Those options aren't for buying. I want to go far out in time, deep in the money. And I'm thinking of a put option, and I'm thinking of a signal that I would look for when the party's over, because what goes up must come down. Chevron, as you can see, has this gentle slope in trend. This is a transient external stochastic shock. I would expect for the price to come back down to where it belongs.
Yeah, and I believe the population is already starting to get upset. So,
Hmm.
great observation. All right, so moving on, I think our next example might be also affected by oil a bit, and that is the ride sharing platform Lyft. And so this is Sam from Hartford, I believe,
Hmm.
wondering if we have a potential setup here.
Well, I got to applaud Sam, because Sam found a symbol. This is actually a symbol that we featured in our program. So we have a premium selling program that people pay to be part of, where we actually all get together and look at the best premium trades. And this was featured a couple weeks ago. And this is one of those symbols where Lyft is actually quite boring. You're right; it could get affected by commodity price, but right now, it as a ride sharing, uh, who was it? I think it was the CEO of GM. GM has traditionally been the top car maker, and it's always hard to stay in the number one spot. but it's pretty easy to stay in the number 2 spot, which was Toyota. And same here, right? Uber is the one that gets a lot of the focus as far as investors go. And so Lyft just easily rides in the background, and it's kind of one of these boring stocks that people follow. It gives a nice little earnings. It doesn't really give a dividend, but it's got this nice pattern that really lends itself to premium selling. And so, what would I do? I got a signal 2 days ago that we might be in a position where we want to either buy some of this Lyft stock, or let's see if we can buy a call option that is a substitute. So, just like I was talking about for Benoit, if I'm going to buy a substitute, I'm going to go far out in time. I'm probably going to go with this January 2023. That's going to give me more than 8 months of time. And I'm going to go deeper in the money. I'd probably use something like, let me do a quick little math here. So, what I like to do, and this is going to be kind of a tricky little thing, a lot of people pay attention to this thing called delta. But if you really want to get down to the brass tacks, take a look at the intrinsic and extrinsic value and look at it as a percentage of the mark price. So I might look at, for instance, extrinsic divided by mark, 1.445 divided by $18.975. That's about 7%. So the extrinsic value is about 7.6% of the mark price. I kind of want that number to be less than 5. So maybe I'm interested in this guy right above it. This guy right above it. This is the January 23 17.5 call. And this would be a option selection that would behave just almost exactly like the stock. If the stock went up a dollar, so would this option. The only difference is this thing, instead of paying $37 a share, I'm going to be paying $21 a share, so almost half. And that gives me that leverage. So this is a great time, Sam, to be thinking about buying some either back month deep in the money calls or buying the stock. Since I'm not getting a dividend, I probably would try to buy those calls. I'd have to look a little closer at liquidity to make sure there's enough liquidity. But if there is, I'd buy those calls. Let's see. I got that signal. I did not get follow through yesterday, and I did not get a follow through so far today. So one of these days, whether it's today or Monday, I'll probably get follow through to that signal. And once I get follow through to that signal, I'll buy that position, and then I'll wait. I'll let that position appreciate like it did 3 times before. And then once it gets to a point where it is done appreciating and it wants to start to work against me, that's exactly, Sam, where I would sell some premium to offset the cost of some protection, knowing that that premium is going to become a paycheck for me, and knowing that if I buy this protection when it's dirt cheap, when I'm at a top, I'll be able to sell that protection when it's the most expensive and probably collect a little bit more of the paycheck, like the frosting on the cake. I'll have 2 sources of paycheck, plus I'll own Lyft stock or own that back month call that I can then watch it appreciate every time the underlying symbol moves up.
Yeah, and this is going to be an interesting dynamic, right? Because the last, well, I'm seeing in correlation to everyone complaining about the oil prices, a lot of it is coming from these delivery type of services and individuals, and so a lot of these drivers have been complaining. So, if oil does, come back down reasonably, I can see that pop there making a lot of sense.
Yeah. Yeah, definitely. And the other thing is don't forget that, a lot of these drivers work for multiple companies. I've noticed around my area here in Washington D.C. that the taxi drivers also are Uber and Lyft drivers, and they just take whichever call comes in first. The other thing that I've noticed about that is that a lot of them have gotten into the delivery service, like you said, because people haven't been taking rides as much. But with all the pullback on the COVID, I have noticed that people are going out. They don't care what's happening in the world. There are people at restaurants, albeit a lot of outdoor seating still, but it's springtime. People are out doing their thing. And I think that there's going to be a lot more ride sharing, the traditional ride sharing, and a lot less delivering your food to your door. So I think uh, owning Lyft or owning a option substitute for Lyft is not a bad thing in the long run. And in the short run, we're going to collect monthly paychecks off of it. So I think, Sam, I think that you picked a really good one. My team also picked it. My program participants also picked this a couple weeks ago. And I think that you've identified a potential reversal signal. I still haven't gotten the follow through on it. So I'm still holding off on doing any sort of those purchases for a day or two till I get follow through. But I did get that signal on, like I said, Wednesday. But I've been waiting. Yesterday, I didn't get follow through. And today, so far, I haven't gotten follow through. So I want to make sure I have a good signal because remember, the rule of thumb, and this is going to sound silly, but buy low and sell high, right? So I don't want to buy and then have it go lower because then I didn't buy low. I want to buy low and sell high. And if I'm shorting, it's still the same thing. People are always saying, I get confused between going long and going short. Well, don't get confused. It's sell high and buy low. You're just changing the order, but you still the rule of, the golden rule is I want to buy low and I want to sell high. That's the golden rule. And so you can change the order of it, but you can't change when you sell and when you buy. If you're selling low and buying high, that's just never going to work out.
Awesome example. We'll definitely keep this one on the radar. As always, if anyone else is interested in getting some of AJ's insight on positions, strategies, feel free to leave a question in the comments, and someone will get back to you, or we'll try and feature it on the show. With that, I believe next week we're going to be looking forward to options expiration.
Yeah.
So when that happens, there will potentially be some new opportunities that we'll keep an eye on. And going
Money,
into
money,
the go,
money.
yeah, going into the weekend, into next week, AJ. I'm assuming we're going to be just keeping an eye on the Fed. Anything else
Yeah.
on your radar?
Uh no. I think that paying attention to the Fed, looking for these opportunities, I think that's where we're going to be. I got to say though, the I feel for those folks in the Ukraine, so shout out to them. I found out that one of our folks in our trading community is based in Kiev, so I'm kind of worried about her. We haven't heard from her in a while. So, anyway, my heart goes out to all those folks.
Yeah, on a positive note, I was reading today that things are they are starting to negotiate it and trying to approach it politically. So, that much better approach than the bombing. So we definitely don't
Hmm.
want to see that, and we wish everyone, all the best in overcoming that, and hopefully we'll see an end soon.
Dude, are
Um,
we on Spotify?
we are on Spotify, yeah. Well,
Guys,
we're now on the video portion of Spotify.
I that's what I heard. I heard that Spotify was now doing video, not just doing audio. So we've always been on Spotify with our audio portion of these shows, but now we're on with video.
Yes, someone over there must have seen our 20 episodes and said, "Hey, let's give these guys a bump."
Dude, guys, if you are on live right now, go over to Spotify and subscribe to our show. It'll give us a little push and it'll get us some more exciting visitors. Also, if you are one of these folks who keeps emailing questions, your questions are amazing. Send me your telephone number. I'm going to record you actually asking the question. That would be cool.
Oh wow, we're gonna be stepping up the production levels here. I like it.
Why not?
All right. With that, I think that's going to be a wrap on episode 21. Appreciate everybody tuning in. Feel free to hit those follow buttons. If you haven't checked out AJ's webinar, the link is in the comments. Go ahead and hit that up. Otherwise, we wish everyone
Smash the like button. I heard
smash
that was
the
like the
yeah. Well, it's not always a like. Sometimes it's follow. So smash the like or follow button.
shows how
Um,
old I am.
you don't. It doesn't look. You don't look a day over 35.
Oh my god. Friend for
uh,
life.
so with that, we'll go ahead and close out the show, and we'll look forward to seeing everyone next week. So have a good weekend, everyone.